Hello, this is Jed Brewer with Study Groups. It's really nice to see you guys today. Thanks so much for taking time in this holiday season to talk a little bit about technical analysis. So how technical analysis can help empower fuel marketers is our topic. Technical analysis is a phrase that maybe you've heard on news channels or elsewhere, and you may have a question of like, what is it? So really two things we're going to address today. What is technical analysis? So some of it's just academic understanding, but the other piece of it, how is it applicable to my business? So how can I actually apply some of these takeaways or learnings and improve things as a fuel marketer in the industry? Very happy to have David Thompson, who's an expert in fuel marketing, hedging, everything fuel related. David is with POWERHOUSE, and just a high level about POWERHOUSE, but they're a full service credentialed brokerage. They work with fuel marketers, many study group members throughout the industry, and really they help with the ins and outs of hedging, of protecting profit margins, their software support along the way, execution of trades, but also really helping people grow their business and taking the supply side of their business and to the next level. So really happy to have David Thompson here to lead us and educate us. We want this to be as educational as possible. So if you have any questions, there's a little dialog box in this GoToWebinar framework. You can type that question into it. I can see that and I will relay that to David at an appropriate time. We want this to be conversational and make sure that you can leave with your questions answered. So please take advantage of that feature, and we'll do our best to take care of that for you. We are going to record this as well as make the slide deck available to you afterwards. So think about that as you're taking notes. You'll be able to share this with a colleague or else. So with that brief introduction, David, I want to turn the floor over to you. Explain to us a little bit about what technical analysis is, but also how can we use it to better our company?
Sure. Thanks so much, Jed, and thank you to Study Groups for giving us this opportunity. We are big fans of Study Groups. Anybody who works to help the fuel marketers and jobbers and distributors, be it gasoline, heating oil, diesel, propane. We work with a lot of companies across the country, and what we like about Study Groups is it's an organization that's trying to help people learn and run their businesses more effectively, more efficiently, more profitably. And we want to try and help bring all the tools that we can to the companies. It may be the fuel trader, it may be the owner, maybe the CFO, maybe the supply manager, to help make better decisions. And one of the important parts of our day-to-day is trying to assess information. We have to make decisions, and we're always faced with something new coming down the road. That's the nature of energy, especially the fuel business. And so when we work with companies, we're always talking about what's going on in the market. And there's really a couple of ways to think about what is going on in the market. And one way is to say there's what is known as fundamental information. This is what's on the news, what's in the newspaper, what's in the morning report you get, with supply, demand, inventory, geopolitical events, weather, regulatory, corporate buyouts and corporate actions, things like that. That's what is known in analysis terms as fundamental analysis. And there's another segment of market analysis called technical analysis. And really, what is that? We're talking about just analyzing the price action. And it's many times sounds confusing, and many times on TV, as Jed was saying, the commenters will gloss over it quickly because it's not something you can explain easily in a 15-second soundbite. But we have about an hour today, so we can actually dig into it a little bit more, and I'm glad you're here with us and that we can do that. As I said, technical analysis is really just studying the movement of price. And the idea behind it is that that's where the money is either made or lost, is what happens with price. There's lots of other things going on, but what we care about is price. And technicians believe that price action tends to repeat itself in sometimes different shapes and forms, but because the market is comprised of human beings with all of our imperfections and our differences in information, there's always what's known as an information advantage or disadvantage. Some people know and hear about something before others do. These are things that are always feeding into the market, but these things cause human beings to respond in what we term as collective herd behavior. You'll see in future slides, we're going to talk about how this manifests itself in fear and greed. But these repeatable behaviors cause trends and other conditions that can be identified. And we try and use that to our advantage as best we can. One important thing is that technical analysis is not an alternative to fundamental analysis, it's a complement. They work together. I always like to explain it this way to people who don't know. If you had to go from Los Angeles to Boston, and I gave you this map, would you rather have this piece of the map? I mean, it's useful, it helps you some of the way, or would you rather use all the tools in the toolbox to be able to get to your destination? So really, that's how we look at fundamental and technical. They work together. You don't have to be only one or only the other. One isn't, you take what works and when it works. If there's plenty of information out hitting the news, of course we're going to talk about it. It's Wednesday, midday, we're going to talk about what the inventory reports were and what supply and demand were. But there's a whole lot of time that we all have to exist and make decisions in the market when we don't have anything going on. And that's really one of the things that one of the first points of technical analysis I want to try and bring out is that it is always there. The action on a price chart is always happening. And you can always try and glean some information from that chart or from other statistics that we're using. And that can help you make a decision when there isn't a new hot story just hit Twitter or is flashing on Reuters or is up on CNBC. So really, we're trying to have more tools to help us make decisions. I would say that
way I describe it as complementary, not sort of a substitution for each other.
Exactly.
Growing up economics tradition, David, so historically the culture has been, well, we're rational beings, we're looking purely at fundamental supply and demand, and prices are moving around based on new events that are coming up, and then people in markets would look just like what you were saying and say, yeah, but there's these predictable behaviors that aren't explained by news releases and other information that we feel like we can gain information from. And in the economics community at the time, there was a sort of a smirk against that, or yeah, these guys are crazy a little bit. But then behavioral economics came along, sort of an offshoot or a branch of it, to say, yeah, there's things like momentum and herd mentality and these innate biases that we have, and if we can understand some of those, we can understand greater things like technical analysis. So I appreciate you helping us become educated on it.
Yeah. I mean, people often think that, and we'll get to some charts, because that, of course, is one of the main tools of technical analysis, but people will say, well, these charts are they're just lines and squiggles. Well, I would say au contraire. I mean, that's actual real money being traded. A lot of people care an awful lot about that. If you're talking about analysis of stock prices, I mean, what do you do in between quarterly reports? You have to make decisions on buying or selling. When I get to this chart, I say useful information is art. It has to be accurate, relevant, and timely. I would say, this is a snapshot of the CFTC, the Commodity Futures Trading Commission, puts out a report called the Commitment of Traders. And this tells you big companies, and several of our clients are big enough, they have to report to the CFTC and say, how many futures contracts do I hold? As a futures trader, and that's what we do to hedge and do risk management for companies, this is vitally important. Which class of the industry how many positions they have? Are they predominantly long or short? This is incredibly important information. It's a government report. You make sure it is exactly right because you're signing on a federal form. So it's accurate, it's relevant, it's very much what we care about. However, it comes out once a week and about a week and a half late. So by the time you're reading this, it's ancient history in the futures world. It helps us to see longer term trends, but if you're wondering day to day what's going on, the Commitment of Traders might be old an hour after it's published. If big hedge funds start moving their positions or there's a major market moving event, they're not going to capture that for another 7 days and report it. So accurate, relevant, but not exactly timely. This guy might be familiar to some if you've watched the business channels at all. He talks about stocks a lot. That's his thing. He's always talking about stocks. He's on seemingly all day long, it seems like, so he's timely. I'm not so sure he's always so accurate. Certainly entertaining, but I'm not so sure always accurate. This is a price chart, obviously. And this, I would contend, is about as accurate, relevant, and timely as you can get. It's the thing we care about. In this case, it's the price of diesel futures on a daily chart. You can have it on a minute chart if you want. You can have it on a 1 second chart practically if you want it. You can have it on a weekly chart. So you can get whatever time frame is relevant to you. It's obviously the thing that we care about. It's the price of the wholesale commodity. And it's accurate. I mean, if there's a mistake reported electronically, it's corrected almost instantaneously. And these days, that's almost doesn't even happen. So I would argue you're getting a lot of accuracy, relevance, and timeliness in a price chart. Why not try to assess if we can glean any ideas about what trends are developing from the price chart? Of course, we're going to listen to what happens to the inventory stats. We're not going to stop doing that, but this gives us another tool. One thing that's interesting, and I want to delve into a little bit, that I think people may not realize this. When I've given presentations on technical analysis, about this time, people, I noticed that, it's almost like the smoke starts to come out of their ears a little bit. If you think about it, you sometimes hear this phrase on television, well, the market's up because there are more buyers than sellers. Think about that for a second. There can never be more buyers than sellers. It's a market. There have to be exactly as many buyers as there are sellers, or the exchange has a big problem at the end of the day. Who was buying to somebody that wasn't selling? Where was that extra buyer coming in, or where is that extra seller coming in? They have to match exactly. So then all of a sudden we're stuck. Well, if there's exactly as many buyers as there are sellers, how is the price changing? Well, for those who trade, we understand there's a thing called the bid and the ask, and that spread between where a buyer wants to buy and a seller wants to sell. That's where the magic happens, because that's what I call in the second point an intensity gauge. Who crosses over to the other side? When does the buyer say, I was hoping for a discount, but I'm not getting it. Gosh darn it, let's go buy it. They don't usually say gosh darn it. There's another word they use. And so I always say, whoever says gosh darn it first, that tells you which way the market's moving. The seller is saying, well, I'm holding out for a good price, and he sees the bids just keep dropping and dropping and dropping and dropping. Gosh darn it, sell it now. I know it's less than I wanted, but I got to get out. I got to take it. It's that intensity gauge. Who is more intense? That determines a trend. Who is consistently going to the other side to take the deal because they're more motivated, they're more intense to do it. So that's what creates price change and creates a sustained intensity, creates a trend. When many people keep saying, yes, I agree. Boy, I wanted to see if I could buy in a slightly lower price, but it's not showing up. Oh my gosh, it just went higher again. Oh, again. Oh, now I need to buy it. Oh my goodness, the price is even higher. And now they're chasing it up, and then finally they say, buy it at the market. Okay, that's a bullish trend. That's what creates that. And that happens all day long. One thing that I think people always ask us is like, well, now that all the trading's on the computers, have things changed? And it's interesting, things have changed. This is a picture of one of the old trading pits, the futures trading pits. And I call this slide the intersection of fear and greed. That's what it looked like. None of these exist anymore. They're almost all gone. Chicago has a few left for some commodities, but even they are tame by comparison. But this is what fear and greed intersecting, meeting looks like. It's loud, it's screaming, it's yelling, it's elbows in the side of the head practically. I've always said I visited the NYMEX exchange many years ago, and I was surprised that people weren't being strangled by these long telephone cords they had running around as they were running into the pit to scream an order to another guy and then running out to report it back to a customer. I was amazed that nobody ever died at the end of a trading day, but they didn't. But all this is gone now. Now it's all computerized. And so you say, well, this changes things, but does it? Because here's what we're all doing now. We're all staring at a computer screen, usually unhappy with the way things are going. So there's still fear and greed. We can't get away from that. And that goes back to what I was talking about, how technical analysis is based in part on the belief that trends exist because human beings are involved, and human beings, as Jed was saying, are imperfect. And we have imperfect information. And so there, that creates this sense of panic and herd behavior, and fear and greed manifest themselves constantly. So until we take the fear and greed out of the market, I think you'll have trends and you'll have things to be analyzed and looking for patterns. So
David, you mentioned the intensity gauge.
Okay.
Is there a way to measure that, like concretely understand when things are more intense or less intense? So looking at the visual that you showed, that kind of allows us visually to see it, but are there other metrics?
We're going to get to two indicators. Jed mentioned, I'm going to try and make this practical and make this stuff you can use, so it's not just textbook. I'm going to define some things just so you have it, so you understand there is a formula to things, but we're not going to focus so much on the formula as what it means to you. And several of the indicators we're going to talk about are indicators that are set up to measure exactly that. Intensity of the trend. Is the trend potentially at the point of changing because of a change of intensity? So those are coming up. Thank you, Jed, for a great preview of coming attractions. But as I mentioned, I want to try to make this as practical as possible. And I had this slide, obviously it's from 2009, but I have it in because it just doesn't ever cease being brilliant. This was a Dow Jones report. Dow Jones, the Wall Street Journal, big time news, financial news. Notice the headline: oil is up as the market eyes inventory builds. So it's saying price is going up as supply is going up. Having read this, I would like to have some of my tuition money for my college economics degree back, if that in fact is the case. But it is, and it happens all the time. As the news reporter goes to talk about NYMEX is up because all this and that, and then finally the guy at the bottom has the most brilliant part of it. He says the market seems to be showing an unwillingness to pay any attention to the fundamentals. There we go. There we go. That's the issue we're trying to address, is what do you do when the market is clearly not paying attention to an increase in supply, which should make price come down, as classical economics would tell you. But as Jed was saying, there's other factors out there. And how do we assess them? When the news reporters call up all the traders and they say, yep, inventory is up, we see it. Well, how come you're paying more? I don't know. They don't want to pay attention to statistics, I guess, today. That happens a lot more times than any college economics professor might expect. That's always been my saying. I really want to go back and find my, I guess it was Econ 303, and have him come and sit in my chair on Wednesday, right around when the inventory stats come out, and say, Professor, let's make a small wager. What do you think is going to happen? And we'll see who wins, but I bet I'll probably do more than he does. But we're talking to people in the study groups who run fuel companies, run marketers, jobbers, retailers, distributors of all sorts. I mean, you're not in this doing this as a trading operation to make money. You don't have a trading desk to make a profit center in your business. So you may think, I don't want to get into this stuff. I'm not a trader. I'm not a speculator. Absolutely not. Powerhouse, we work almost exclusively with people who are doing hedging. But jobbers have to make decisions on when to acquire inventory. Heating oil distributors have to decide when I'm going to launch my winter cap price program. Gasoline retailers have to determine, hey, when am I going to try and protect against the spring margin squeeze that's coming up? Hedges I can do, but when do I put them on? Each of these points, each of these decisions involves an element of timing, and technical analysis can help with that. So that's why I think it would be useful. It gives you a tool to help you try and look at timing issues, when to buy, when to sell. Separate from fundamentals, but not not ruling them out, but just when there's nothing else there. One thing that's important I mentioned is that the technical analysis can work on any time frame. You can look at it on a 5-minute chart, an hourly chart, a daily chart, a weekly chart, a monthly chart. So it can work whatever way you work with your business in making decisions. If you're the guy who's got to buy and sell every day, then you probably want a shorter term time frame. If you're the owner of a company who's deciding, should I launch my heating oil cap program this week or next week? Maybe you're not looking at so much an intraday chart, but more of a daily chart or a weekly chart. But it gives you great flexibility in how you look at the data. Another important thing is that there's different ways to do it. And we're going to start with digging into one of the most classic indicators out there, and this one's probably you've heard a lot on television. It's called relative strength. Sometimes you'll hear the phrase overbought and oversold. It's probably referring to the relative strength index. It was developed all the way back in 1978. Actually, it was published in a book. I have the book. You can buy the book online if you want to. It's widely used, and it compares the magnitude of gains when the market's up versus the magnitude of losses when the market's down over a particular period of time. Could be days, minutes, hours, weeks, but it's called a look-back parameter. In the last X number of days, how much of the winner's been up when they're up and how much of the loser's been down when they're down. And it creates an index through a mathematical little simple arithmetic at the bottom to give you a banded range between 0 and 100. So it oscillates. It goes up and down between 0 and 100 to give us an idea, relatively speaking, that's relative strength, how strong the market's been. The idea that when the market's strong, you're going to have more days in which the gains are bigger than the days when there are losses. Obviously, markets don't go up every single day. It could in a 14-day period, but it's highly unlikely. But of those days up, how strong is this 14-day period? And it's great because you can compare it to different time frames. All these things are useful. But the one point that's interesting is that it was published in 1978. 1978, 46 years ago. 46 years, and it is still on every trading computer out there. Still on every financial website. You can pull it up and find the relative strength index. This is a page from the book. I call it Technical Analysis Pre-Supercomputers. He has the formula right there. Look on the right page, on the right-facing page. You can see the screenshot. Wells Wilder, the man who did this, actually wrote handwritten notes on a piece of graph paper and calculated with a Texas Instrument handheld computer and graph paper the math. So it's been around this long, despite everybody knowing that, well, if things get arbitraged away, things go away, nothing stays the same. Things move around a lot, but human beings, with our fear and our greed, that can be measured in that intensity through things like the relative strength tool, that hasn't changed yet. But it's amazing. 1978, done with a handheld calculator, pencil and paper writing numbers in the column, and it's still around today and still effective today. So, okay, there's this relative strength thing. It measures the strength of up days versus down days, and it gives me a number. What the heck do I do with that? Aha. There's two settings in your relative strength, and you'll see them in the second when I get to the chart. One at 70 on the upper band, one at 30 on the lower band. We call these overbought and oversold. And we'll explain how we do things when we look at this idea. This again is the diesel futures chart, ULSD futures chart. It's running since May through present. It's a daily chart. So each of those bars is a day. Obviously, green is up, red is down. And then the bottom in that light blue color is the relative strength index. And I calibrated in this case for a 10-day period. As a futures trader, I look at it and say, well, usually I have a 5-day trading week, so 10 periods is 2 weeks time. You could do 14 days if you wanted to, but I figured 10 days is actually 2 trading weeks most times. And I've run this analysis. I put this recent period of time, about 6 months time, and I have 1, 2, 3, 4 points in the squares I want to draw your attention to, and then little circles and color coding corresponding circles. Upper chart is the price, the bottom is the relative strength. You can see when price dips over a period of time and reaches that area in late May, where box number 1 is, we reached what was called oversold conditions. In other words, that blue line dipped below the 30 level. And that's telling us that there's been a sustained period of weakness in price. And it's reached a relatively extreme level. And that gives us a clue that there might be potentially a situation where there's just been so much selling that the intensity of the sellers has become exhausted. There's only so many hedgers who decided as price was going down, gosh darn it, I should have hedged last week, I could have protected that inventory, I didn't. didn't call Powerhouse and get short. I knew I should have, but I didn't, and they do so now. And now they've done all their hedging. And it may be the speculators have said, I don't want to put any more short positions on. I'm waiting for a turnaround. Whatever it is, these things we don't know, but we can measure that intensity. As Jed was saying, how heavy has the selling been? How many days when it's been down has it been down much more than it's been up over a 10-day period? And we can create an objective marker. That's what the relative strength index is. It doesn't care about news, doesn't care about OPEC, doesn't care about weather, doesn't care about the weekly supply report. It's just saying all those things happened. We're not discounting they happened, but they showed up on that price chart. So when it reaches overbought, is it guaranteed that it's going to turn around? No, it could stay there for a while, but in this case, it did have a turnaround in price. It led to a decent little rally, which brought us up to that part, that new area around box number 2, where we were sort of at a high water mark right at the beginning of July, that looks like. And there we see the mark, the blue line, got over the 70 level. And that's what we call overbought. In other words, the buying has been intense. As you can see, look at that period from late May to basically the entire month of June. We had strong up days and the down days were relatively minor. That's what created that 70 value in that relative strength index. And again, it's nice. We don't have to have the pencil and paper like Wells Wilder did back in 78. The computer just calculates for this and we see it each day when we turn on our monitor. But now we see we've hit an overbought level. And this leads to a period where we had a nice sustained sell-off. So what does this mean for the fuel supplier? This tells you, hey, if I hadn't bought anything and I still had some time, maybe I might want to wait, give it a day or two or a week or two, because we've reached an overbought condition. There's been a lot of sustained intensity in buying, and the market, as we know, goes in ebbs and flows, and maybe this is just a little bit overheated, and I might want to serve me well to wait for a pullback. In this case, it did. And then we move over to point 3, and we see it again, this setup once again. You had a period of July, August, and half of September, it looks like, as you were just basically selling off. And this gave us all the way back down to an oversold condition again. There again, if you wanted to take an educated shot, in conjunction with fundamental analysis, hey, the market's oversold, and inventory report came in with less supply than expected. That might be 2 combinations that would lead me to think that there's a bullish reaction ahead in the market. So that would be something to look at, as a decision tool to say, hey, I want to take these in conjunction with each other, both fundamental and technical. But the nice thing is you're always able to see RSI. It's always there. You can look at it at any point in time and you can get a reading and say, hey, overbought, oversold, sort of in the middle. What do I know? And so you'll have a piece of information, even if you don't have inventory statistics, even if there isn't any decision from OPEC about what to do on the supply levels. You'll have this here available to you to help you decide what you need to do.
Help me think through this a little bit, David. So going over to the far left of the chart, I'm looking at that relative strength index metric you were talking about, that bottom circle. So we've crossed below the line. So before we cross below the line, maybe we call it a random walk, but it's a crapshoot. It could be up today, it could be down tomorrow, relatively similar odds. Once it crosses below, are you saying that the probabilities change? Like, sure, yeah, it could keep going down, but maybe the probability that it goes down is less now than the probability that it's going to turn and go higher? I
like to think of it sort of like the idea of Newton and the apple. I mean, we all know that the apple fell and hit Newton on the tree, on the head, and gravity. Well, actually, he was also doing something. The story says he was also tossing the apple in the air and observing that he throws the apple up and it goes up, but there's a moment where the apple isn't going up or down, that moment of zero, and then it starts accelerating back down again. Same thing here. In that case, before the first circle at 1, before those 2 yellow circles, the market wasn't just in a crapshoot, it was moving on a sustained downward path. That was what was decreasing the relative strength, moving it lower, 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 lower. We use 70 and 30. Those can be tweaked depending on the commodity. But we're looking at, hey, below 30, that selling has been overwhelming in the last 10 periods in this case. So that starts to lead us to an educated guess that, just like the Apple, how many times that, trends don't go on forever, and this is now reaching an extreme point. The odds start moving a little bit better that, wow, at some point there's going to be a reversal, a reversion to the mean, if you will. If only because this completely technical measure, not caring what Jim Cramer says on TV or anybody else, just saying I'm adding up the winners and losers each day, and this is typically for this market doesn't get that far oversold before it reverts. That's why I'm saying it's important to calibrate these to your commodity that you're trading. Crude oil might be different than heating oil. Gasoline might be different than natural gas. You want to make sure you have the right sensitivity to things. But as we're trying to look and scale, you'll see that in these areas between the yellow circle and then the green at the top after the rally phase, we're trying to capture major moves in the commodity we're looking at. We're probably not trying to be so fine-tuned that we're using this for a day trading tool, because that's not really our purpose. We're trying to find out, hey, is there likelihood of a larger term change in the trend that's going to be a 30, 40, 50 cent a gallon type move in refined products? That's probably what most listeners care about. So that sort of get to a little bit of what you were thinking, Jed?
Yeah, I also find it interesting that different commodities or stocks or whatever could have tighter bands or looser bands as well. The more volatile the commodity, you may have a wider band, and something that's relatively stable on Walmart sales or something like that, it just tends to go, may have a tighter band around it. So when you see deviation from those bands, it catches your eye.
Yeah, that's right. And also the look back period will affect how volatile and how quickly it moves up and down. A longer look back period will make it more tranquil. It won't have as much of like a Richter scale look to it, versus if I made this a 5-day look back period, you'd have a lot more herky-jerky action in the chart. Again, we're working with a particular class of people who are involved in the market, and they tend to have a similar time frame. Again, we're not day traders, nor do we seek to be on the internet. But yeah, this gives us an idea of overbought and oversold. And this, through the last couple of months, the diesel prices had a couple of times where it's reached extremes. The overbought, the high bond tends to be a pretty slightly stronger indicator in the last couple of months. It's interesting. So when you get overbought, it usually, if you have to buy, it pays to maybe wait to see if we get a little bit of pullback in price. That's been fairly consistent in the last 6 months in diesel. So that's when you hear overbought, oversold. That's what they're talking about, and this is how you can use it. And the great thing is, overbought and oversold works on stocks, works on bonds. We're just trying to measure the intensity of sellers versus the intensity of buyers when they have these, when they express themselves in the marketplace. Okay, Bollinger Bands, completely different tool. This one is probably won't hear all that much on television. Sometimes they get into it. On the technical segments, they will. John Bollinger is alive and kicking. I met him last year at a conference in DC, 2 years ago, I should say. A nice guy, and he was doing this back in the 70s as well, and was trying to measure volatility and understanding how volatility changes. Nobody minds price when it just moves around a little bit, but it's the big moves that either hurt us or get our attention for sure. So people would usually use like moving averages and bands around the price, but they weren't very effective. Bollinger came up with this idea of a mathematical way to create bands that moved as volatility changed. So they didn't stay static. And the goal was to try and answer is price high or low on a relative basis. So let's show you a little bit of what we're looking for. The biggest thing in this thing is this width of the bands and identifying what's called a squeeze, when the two bands, as you'll see in a second, get very close together. I'm actually jump ahead. This is this is diesel futures, and the orange line in the upper pane, that's the Bollinger Bands. I'm keeping the RSI in the bottom pane, the tool we had before, so I can add multiple technical tools in one frame, and many people do. This orange Bollinger Band is what we're looking for, measuring volatility in the market. And we're looking especially for these points where it constricts. What that's telling us is volatility has gotten very low in a market. And it tends to resolve with a rather explosive move. Bollinger Bands don't tell you up or down, but they tell you when the price has been relatively tranquil and relatively not volatile. This is important if you're buying options. You want to try and buy an option in a low volatility period, be it a put or a call. Either way, you'd like to have less volatility because volatility is a cost component in the option premium. So here we're looking at, on the far left of the chart, that was right around the time when we were looking at oversold the first time, but this is a slightly different period. It's a little bit earlier. So that was telling us, hey, this market has been relatively quiet. The moves haven't been that big. They may have been moving down, but it's getting quiet out there. And something might be coming. In this case, it was one more sharp sell-off followed by the rally. Moving over to that second yellow oval, right around the 1st of October, there you've been sort of moving sideways for about a month, give or take in September. It was up slightly, but certainly not as clear a trend as it had been the prior 3 months. But the market had gotten quiet, and then you had a major pop. Again, now we know it happened to be on Middle East events, but the Bollinger Bands were telling you before the Middle East events happened, this market is relatively tranquil, and commodity markets don't tend to stay in that state. They tend to be this constant expansion and contraction of volatility, pulses, if you will. And those are useful for us because, again, if we want to try and establish a position, if you were thinking about option positions, those are good to buy when they're down, or option spread positions. Those are things you want to buy in low volatility environments. Let's talk about one more thing, and this really sort of fits into something that is happening right now that applies to the gasoline markets, and that's this concept of seasonality. Seasonality is a technical term because it just meant we're measuring prices. We're comparing them to dates on the calendar, but we're not concerned with supply or demand. We just want to say what's happening with the pattern of prices as we move through the year. Seasonality is obviously the tendency for a commodity to perform bullishly sometimes and not at others. There's no guarantee that seasonality repeats itself. There's no guarantee that past performance equals the future. But we're trying to take a consensus of information that we have and at least determine, I always say, so what direction is the stream flowing? Is it typically at this time of year bullish or bearish? It may not stay that way. Things may be different this time, but I at least want to know what the preponderance of the evidence is from past behavior. And I can use that as a guidepost to follow or not follow, but that's what I'm trying to do with seasonality. The interesting thing for us as futures traders and hedgers, who work with people in the field business, is that seasonality can be analyzed for specific futures contracts. And this is a big advantage, I think, that not a lot of marketers know and understand, is that if you're talking about you're a gasoline retailer and you know that your profit margins tend to get squeezed in the late winter, early spring, and you're wondering how I could hedge that. There's something you can do for a hedge, but what you care about are really specific months of the year when you're getting squeezed, and those futures contracts that are setting the price, the wholesale price at that time of year. For instance, the April, May, June RBOB contracts on the futures markets are usually of importance to gasoline retailers because when those start to rally in price in the late winter, early spring, that's when things really start to get pinched on your gross profit. Either you're losing margin or you're losing volume. And what we try to do is say, okay, there are hedges I could put on that can protect against that, but when do I put those hedges on? How do I make that decision? That's not something you're going to read about in the Wall Street Journal or see on CNBC, but we can look at those futures contract months and try and determine when do they make their low points. And this is exactly what we do every year for our gasoline clients, is we go through and say, hey, I'm going to look at the June gasoline futures contract. And what this chart is showing is two lines, orange and white. The white is the average of the prices for each day of its life of each of the June RBOB contracts from 2019 through this year, 2025. So each January I take what was the price in 2019, what was the price in 20, 21, 22, et cetera, and create that average. So the white line at the bottom is the average of RBOB prices over each calendar day. The orange is where we're tracking so far this year. So this chart tells us many things. It tells us that right now, gasoline prices are higher than they were on average of the last 6 years for the June contract. But look at this pattern you can see. You know, the white line is giving us this pattern that, boy, early December, June RBOB prices start a very clear uptrend. That big drop, as you can see, if you notice, that's in the month of February into March. You can all probably remember, although in 1 or 2 years it's going to start to drop out of the charts. That, of course, was COVID, when the massive drop from COVID hit. It made that much of a dent in the chart. If I took out the year 2020 on this analysis, it would be just a straight line up. Wouldn't have that big dent down in it. But 2020 happened, as did 2022, so we can't take data out of the charts and be an honest analyst. But we can see there's a strong seasonal trend for RBOB futures to advance, usually from early December. So this helps us go out and talk with our gasoline retailers and say, hey, if you want to put on some protection for that margin squeeze that's coming, now is probably a pretty good time to look at doing it. So again, these are, like I call them guideposts. Is it always going to be low in December? No, that low has moved. Each year we assess it and see if it's changed a little bit, and it does. But the general tendency for wholesale gasoline prices to rally in the early spring has stood the test of time. And you know, we want to try and be as much in the ballpark as we can when we're making decisions. But this is the window to start talking about protecting your spring gasoline margins. So that's another.
About this, David, I think as long as I've known you, and like you said, it often to repeat, not every year, but you help people get out in front of it.
Exactly. I mean, you know, the wonderful thing about gasoline retail is that, you know, there's half the year you're doing pretty well. Margins are pretty good. But the nice thing about hedging is it's unlike vehicle insurance where, you know, you can't just buy it for pieces and parts of the year. You have to buy it for the whole year. In gasoline retail hedging, we just really concentrate on 3 or 4 months a year to try and protect things and look at it as saying, hey, I'm going to buy some insurance from, you know, my good months. I'll take a little cents per gallon when I have some nice fat profit margins in October, November. Buy a little bit of protection that helps get me through the potholes of, you know, February, March, April, May, that type of time. So, you know, that's a thing. But when we talk about how do we make decisions when to do that, this is one of the key points we look at is this seasonality. When should we start looking to jump in? We don't want to jump in too early nor too late. But this helps us give us this roadmap. And seasonality is another thing. It doesn't have to be complicated. A lot of these indicators, people, they want to sound smart because they want to sell a book. And that's fine. Books are good, and we ought to have them. But you know, we all have a busy life. We don't have time to do all this all the time. So you can keep simple tools that work. The other thing I would say, if you notice, I talked about seasonality, which is looking at the aggregate of price patterns. I talked about volatility, and I talked about momentum, that overbought and oversold. These are 3 different sort of schools of thought, if you will. It's important if you're doing technical analysis to keep those sort of different schools of thought. If you look at 3 momentum indicators, they're all going to tell you the same thing roughly at the same time. They might have different names and slightly different calculations, but they're the same thing. They're measuring the same thing or the same way of measuring things. 3 volatility readings will probably tell you the same thing. I mean, you can change time frames, but you know, if they're this apples to apples, they're going to show the same thing. Same thing with other chart patterns. So you want to try and keep your things you're looking at. If you're doing technical analysis, you want to have different schools. And that way you can say, wow, if my momentum indicator is telling me a bullish preponderance of the evidence is here, if my volatility is telling me, ooh, this is sort of a quiet market, not a lot of action lately, and I see a seasonal low point on my seasonal chart, wow, okay, you know, that might inform my decision to be long or short. And so I'd have those sort of three different schools of thought kicking in, giving me reasons to make a decision. If they all sort of lined up in the same direction, I would feel more confident from a technical point of view of saying, you know, I should be long or short based on this. So that's really how we try and look at bringing these tools into the marketer to help them. You know, the one thing I would say is don't get trapped in, I must wait until an indicator tells me something, or the indicator is saying this or that. I mean, price is always the ultimate indicator. What is the price doing? You can want an indicator to flash a signal, buy or sell, but the price really has to be the thing that's driving your decision. Technical analysis its great advantage is it's always there for you. Even when you don't have something out there that you can hang your hat on with the fundamental story. This can also be useful for marketing to share with clients. Sometimes they, what's going on? And they ask you the job or the supplier, and you may not have a good answer, but this is a valid school of analysis that can help you tell another story sometimes to clients, and that's useful for them. So as I said, we try and work with these in concert, because there's just a lot always going on, and we always want to have some way to try and help us make a better decision, and we found this to be useful for marketers.
Is there a place that people should start? Say they're new to technical analysis, where you would guide them?
There's a great source of free information, and it actually comes from the stock trading world. It's called stockcharts.com. The first quote, if you remember back in the first slide, I had a quote from a man named John J. Murphy. He's really sort of the father of a lot of technical analysis, wrote some fantastic books on things. He started this website, stockcharts.com. I mention it because it has a wonderful dictionary of common technical terms with really good explanation pages. It has lots of ways to create charts, but if you're looking for a thesaurus of technical terms, you're always wondered what something meant. What's an oscillator? You can go in there and look it up, and you'll know more than you want. But stockcharts.com is a really good free resource. That's something that I would always say if you just need to learn some terms. You can also create charts there. You can even create commodity charts. You have to know sort of what the symbols are, but call us, we can help you do that. That's very useful. I would think there, just if you're starting to do things. There's some, if you're interested in books, I mean, nothing makes me happier than talking about technical analysis books. That Wells Wilder book is fascinating to read. If you like the symbols I was using on my charts are called candlesticks. They came from Japan. There's an American went over to Japan many decades ago and looked at their charts and said, "Oh my gosh, you guys use a completely different chart than we do." And the Japanese said, "No, we just use a better chart than you, because it tells me more information when I glance at it." There's a book on candlesticks as well, and I'd be happy to send you a list of sort of the 3 or 4 books that I like a lot.
We moved over that quickly, but the candlesticks are the red and the green.
Yeah,
and
exactly.
Showing the difference between the opening of the market and when the close is, and
That's right.
the useful information and seeing that intraday movement of prices.
Right. And before, I don't know if people remember old charts, you had what was called a bar chart, which was just a vertical line, a little hash mark on either side, which is the range of the day is how tall the line was. And then the one hash mark on one side was where it opened, and the other hash mark is where it settled, where it finished. The candlestick chart tells you the exact same thing. It tells you the open, the high, the low, and the close, but it gives you a much more satisfying visual picture to look at and say, as opposed to looking at these little hash marks that just look like chicken scratches on the page. When I first started looking at this, I'm like, my goodness, why wouldn't you use these things? It's just much more intuitive to what's going on. And you see, look at that second yellow circle, and then all of a sudden you have 3 big up days, 2 massive big green bars. I mean, wow, okay, that's a heck of a move there. That'll catch your eye. So these are other tools that are all written out. Wonderful people have taken the time to put all their formulas into books that are useful too. But if anybody's interested, I'd give you a quick list of wonderful books.
Taking the time here to educate us on a few of these strategies with technical analysis. You provided some resources that people can go to as well. And I know that you and POWERHOUSE are always open to conversations with people, and you've got a ton of institutional knowledge around this. So you're obviously a resource that people could lean on as well as they dip their toe in the water or get more involved in it. For the audience, just appreciate your time here on the call. Here's David's contact information. Again, we will send out a recording of this as well as the PowerPoint slides if you like to view it a little bit more. And just wish you a very happy holiday season. However you're celebrating it. and looking forward to connecting with you again in the new year. David, thank you, and goodbye, everybody.
Thank you.